Today we're going to take a look at doing a statement of cash flows. And this first section, we're going to start out looking at our source documents, which is a comparative balance sheet, means it's got 2 or more years on it. And it also we have an income statement that we only need 1 year's worth of the income statement. And we have some additional information that might have been pulled out of the general ledger. And so we're going to use this information and make the analyzing tables, which will then help us greatly with doing the statement of cash flows. Now the cash was $1375 at the end of 2019. Always our most current year is shown in the first column. At the beginning of 2019, i.e. at the end of 2018 or January 1st of 2019, we started out with 1540. So we went down from 1540 at the beginning of the year to 1375 at the end of the year. And with the statement of cash flows, we want to explain everything that happened to get from the beginning to the end. And why did it go up and why did it go down, and analyze all the various accounts. Now we know from our PowerPoint and video, we know that the operating activities is going to involve the current assets and the current liabilities. So we have to be able to know which accounts are the current assets and the current liabilities. So the current assets are all those accounts that are going to turn to cash or be used up within a year. So cash, of course, is already cash, but we're trying to explain cash, so that's kind of a separate thing. Accounts receivable, usually we'll receive that in 30 days. Supplies, will usually use that up in a couple of months. If we had prepaid insurance, that's usually a year or less. Inventory, usually we'll sell that in a few months. So those are all examples of current assets. Now, when we get down to long-term investments, we can see LT, long-term. Anything below that are long-term things, long-term assets, and therefore they're not current assets. And they're not going to be part of the operating activities. Long-term assets, these investments, the equipment, and the accumulated depreciation of equipment, those things are going to go as investing activities. Then for our liabilities, accounts payable is usually due within 30 days. Wages payable is usually due very soon. And so those two things will be current liabilities. Long-term notes payable, again, that LT, long-term, is going to be a long-term liability, and that's going to be a financing activity. And we have stockholders equity, and everything that's in stockholders equity is part of a financing activity, and will have to go on the table. So we need to make tables of everything that's going to go in the investing activities, these long-term investments, or the financing activities, which is the long-term notes payable, and the stockholders equity. So we're going to need a table for each one of those things. Now, the current assets and the current liabilities, those are going in operating activities, and we don't have to analyze what makes them go up, what makes them go down. We can just look at the difference and put them on the operating activities. So the rest of this particular video, we're not going to be talking about those. We're going to be talking about analyzing tables. So we'll be talking about the long-term stuff. Now let's take a look at, I'm going to make a slide for each one of our tables that we need. Okay, and so here we're going to start out with our long-term assets, and we have long-term investments, and they went from 2150 to 1800. Okay, so I go onto my slide and okay, this is my long term all right, a little bit sloppy this way, but okay. And all of our tables, we have a beginning, we need what makes it go up, what makes it go down, and then an ending. Okay, so we said our beginning is 2150 and our ending is 1800. Okay, so we've got our beginning and our ending in there. Now we need to know what would make the long-term investment account go up. We can't just have the plus there. We have to have a word there. Why would it go up? Well, long-term investments would increase if we bought more long-term investments. So those might be we've invested in some real estate, maybe we've invested in some stocks or bonds, but we've invested in some things that we've put some money into those things, and then we hope that they will increase in value and we'll sell them at some point in the future and make some money. Okay, and so okay, so if we purchase the long-term investments, they're going to go up. If we sell the long-term investments, they will go down. Okay, and so now here we have gone down, and so obviously we sold some. Now the whole difference between 2150 and 1800 might not all be the cost of what we sold. So we have to look into our additional information that we were given. So we're going to go back here to our original information, and down here at the bottom we have additional information. Long-term investments sold for $550 and there were no investment purchases. And none of the rest of this is about investments. So we know that there were no investment purchases. The long-term investment sold for $550. Okay, so we have a 0 for our purchases. So the entire difference between 2150 and 1800 is going to be the cost of the investment that we sold. Okay, so that is what, $350? Okay, you want to make sure that you take your beginning, you add whatever you have for the add, you sell whatever, you subtract whatever you have for the minus, and make sure, does it equal the ending? Does 2150 plus 350 or minus 350, I'm sorry, equal the ending? And so yes, it does. So I can put a check mark there to show that yes, I double checked it and made sure that my numbers work that way. Now, we also need, whenever we sell something, we need to do a book value table and a gain-loss table. And so our book value table is going to be our cost minus any accumulated depreciation. That equals our book value. Okay, now the cost is what was in that account that we had to subtract when we sold it. And so that's $350. Now, whether this is land or long-term investments that you're selling, neither one of those things gets depreciated. Depreciation is like for equipment and stuff. So our accumulated depreciation is 0 because we don't depreciate investments. And for all of you in Accounting 102, your sale is going to be a sale of land or investment, something like that. So you automatically know that there's no accumulated depreciation. So 350 minus 0 is 350. That's our book value. Okay, now I need my gain or loss. And we have the amount received minus the book value. If you write out your formulas all the time, you actually write out what you're going to do, it will help you a lot. Okay, if that's a positive number, once I subtract it, then that's going to be a gain. If it is a negative number, it'll be a loss. Okay, so we need to know the amount that we receive for this. Now, sometimes you're not told, okay? Sometimes you're told some other piece. In this case, we were told that the amount we received was $550. What if we didn't know that? We know the book value, we just calculated it. That was $350, okay? We know the gain and loss. Okay, so let's take a look at the gain loss. That's going to be on our income statement. Here it is, gain from sale of investment, 200. Okay, so we have a positive 200. Okay, so how much must the amount been received? Must have been 550. So even if we weren't told that, we could figure it out. So the amount received of 550 minus the book value of 350 is a positive gain of 200. Okay, so when you go to put this information into your statement of cash flows, you're going to, this 350 here from the table goes to that cost there. Those match against each other. This book value here goes to this book value there. So those get crossed off. Of course, anything that's a 0 you can cross off. Okay, the 200 gain or loss, that was already taken care of in your operating section. So we can check that off. So the only thing left, this is what's going to go on to your investing activity section. You're going to say sell. We sold a long-term investment and for $550, and that's what's going on to your statement of cash flows. Okay, so let us continue on. So we took care of long-term investments. Our next thing is equipment. It went from $4,500 to $5,800. And generally I try to do the accumulated depreciation at the same time. That went from 100 to 300. Now, whenever you have a contra account that's in the same column as the things that's attached to but has an opposite balance of, so all these are assets, they all therefore have debit balance. This is a contra asset, it has a credit balance. You're going to show this as being subtracted because of that opposite balance. It doesn't mean that this went from negative 100 to negative 300. It just meant it goes from a credit balance of 100 to a credit balance of 300. And of course, the accumulated depreciation account has a credit balance, okay, normally. So that's all normal and everything is fine. It went from 100 to 300. Now, if I take a look at here, it says that no equipment was sold, okay? And none of the rest of this deals with equipment, okay? So our equipment went from 4,500 to 5,800. Okay, so we've made our beginning and ending into our table, and then we have to say what would make equipment go up. Equipment would go up if we purchased more new equipment, and it would go down if we sold any of the equipment that we already had. And so then we look at our additional information and we saw that we did not sell any equipment. So we can go ahead and put a 0 there. So that means the whole amount that went from beginning to end, from 4,500 up to 5,800, which is 1,300, that whole 1,300 was where we purchased assets. Okay, and we've double checked 4,500 plus 1,300. Does that equal 5,800? Yes, it does. I can check that off. And this is what's going to go on my statement of cash flows. I'm going to say purchased equipment, 1,300 in the investing section. Okay. And of course, I can put any check mark next to any 0 stuff so that I won't have to worry about putting that anywhere. Okay. So now let's take a look at the accumulated depreciation. Okay, and we went from 100 to 300. Okay, now what makes depreciation, accumulated depreciation, go up? Well, every single time we depreciate, we calculate out depreciation stuff, we always have a debit to depreciation expense, and we have a credit to accumulated depreciation. Okay, and so every time I calculate and do a journal entry for depreciation, I'm increasing, because accumulated depreciation has a credit balance. So every time I credit it, I'm increasing accumulated depreciation. Okay, and so it goes up if I have depreciation expense. Okay, I know this is not the easiest thing to see with my it's kind of hard to write on these slides, but that says depreciation expense. That makes it go up. What would make accumulated depreciation go down? Well, if I sold a piece of equipment that had accumulated depreciation attached to it, when I sell that equipment, I also have to take that accumulated depreciation back out of the books that went with that piece of equipment that I sold. So when I sell equipment, okay, I'm going to decrease my accumulated depreciation. Now, we were told, and the additional information, that we did not sell any equipment, and therefore we're going to have a 0 for the sell. And so all of the difference between the 100 and the 300, which is 200, is depreciation expense. So we have a beginning of 100 plus 200 that we depreciated this year equals 300, so that gets checked off. Okay, anything with a 0 gets checked off. And this depreciation expense, okay, now remember that's a non-cash activity, and so that goes into our operating activity section, not into our investing activity section like all the rest of these long-term assets. Any depreciation expense is going to go into the operating activity section. Okay, so that finishes our long-term assets. Now let's take a look at our long-term liabilities. We have one, long-term notes payable. It went from $2,500 to $3,500. So let's check if there's any additional information. Okay, it said that we issued a $2,500 long-term note. Okay. Okay. Again with 2,500 and we ended up with 3,500. Let me just double check that to make sure. Yes. Okay. Okay. Now, what makes long-term notes go up? Well, if we issue new notes, meaning I go to the bank and I sign my name on the dotted line that says I promise to pay back X number more. Well, now that's going to, I'm going to have more cash in my hand, but I'm going to credit notes payable, okay, if we issue new note, okay? And what makes the note payable go down? Well, if we pay on it. If I pay it off, or even just pay on some of it. The word we use for that is redeem, but if you put paid, you know, that we paid on it in your statement of cash flows, that's fine. Okay, but know that the correct word is redeem, means that we're paying on this. Now, we were told in our additional information that we issued a new note for $2,500. Okay, so we can put that in the issue part. So now we have to figure out, well, how much did we redeem? Because if I add the beginning $2,500 plus I issued a new note for $2,500, that's $5,000 total. But I actually at the end of the year only owe out $3,500 to the bank. So I must have paid some. whatever it takes from 5,000 to 3,500, which is 1,500, I must have paid off 1,500 of the old notes. So you want to make sure if you add your beginning plus your issue, that's 5,000 minus your 1,500. Does that equal 3,500? Yes, it does. So I can check that off. Okay. Now the issued new note, that's going to be a financing activity. So we're going to put it just like that on our statement of cash flows in the financing activities. We're going to say issued new note 2,500. Then also in the financing activities, we're going to say redeem note payable 1,500. Okay, and so once we get both of those onto the statement of cash flows, then we can check them off on our tables. Okay, now we're down in our stockholders' equity, and we have no par common stock. Now, if you have on your final exam, if you have one that has a paid-in capital account, then I usually do those together, the common stock and the paid-in capital together. They are hitched together. It's not a contra account. It doesn't have an opposite balance, but that PIC account goes with it. Okay, so but here we don't. It's no par stock, so we don't have a PIC account. So it went just like our notes. It went from 2,500 to 3,500. If I look here in the additional information, it says that we did issue common stock. Okay, and so I have okay, and we started out with 2,500. We ended up with 3,500. Okay, and we have to put down what makes it go up, what makes it go down. If we issue new common stock, then that would make the common stock account go up. And if we retire common stock, so when we issue common stock, people give us cash and we hand them a stock certificate. And then they hope that our stock price goes up. And if it does, then they can sell that stock certificate to somebody else and make money on however much the stock price went up. Okay, it's not like a note or a bond. Bonds payable are kind of like notes payable, except instead of the bank that we owe out to individuals who invest in our bonds. We issue bonds and then we have to pay them back, and we have to pay back interest. But now common stock, if we issue common stock to people, we don't have to pay them back. If the stock price goes up, they'll make money when they go to sell that stock. If the stock price goes down, they will lose money. Okay, so they will not be happy, but we do not have to pay them back. Okay, now we might want to buy back some of that stock. And so, such as Dell Computer Company. It was privately owned by Michael Dell. And then he decided to go public. So a bunch of stocks were issued, and this company got all kinds of money coming in, and they issued out all these stocks. Well, then at a later time, decided he didn't want to do that anymore. He wanted to go private again. And so he bought back all the stocks that he had originally issued. He bought them all back and retired them so they wouldn't be resold again. Okay, so if we do that, that would make the common stock account go down if we retire the stock. Now, in Accounting 102, we're not going to deal with retirement of stock. So you can automatically know that the retirement will be zero. Okay, so that means the whole amount that we went from the beginning to the ending, from 2,500 to 3,500, was all where we issued stock. And we know that we did issue stock. It didn't tell us how much in the additional information, but we know how much it is now. 2,500 plus 1,000 does equal 3,500. So I can check that off. And I can check off anything that has a zero. So this issue of 1,000, that is going to go on to my statement of cash flows. In the financing section, I'll say issued common stock for 1,000. If you know how many shares of stock, then you should also say issued 100 shares of stocks or whatever. And otherwise just say issued stock. All right. We have one more account to go for our tables, and that is the retained earnings. And so we went from 3705 to 3085, okay, when we did our retained earnings. Okay, 3705 to 3085. Okay, what makes retained earnings go up? Well, retained earnings for a corporation is where we close out the closing entries into. Remember that when we closed things with a sole proprietor in Accounting 101, we closed out revenues into income summary. We closed out expenses into income summary, and at that point we had net income is sitting in the income summary account. Then we closed out income summary into the capital account. Okay, and then we closed out drawing into the capital account. Now here, with a corporation, we separate out the owner investment. And the owner investment section is common stock. And so any owner investment stuff is put in the common stock. And all the rest of everything that we think of as going in capital, which is the net income or net loss that gets closed into there, and the owner withdrawals get closed into there, well, that stuff goes into an account called retained earnings. Okay, and so if I am closing out income summary and I have a net income, then I'm going to debit income summary and credit retained earnings. Okay, and so that will make retained earnings go up. Okay, so net income being closed into it would make it go up. Now, if I had a loss, then I need to credit income summary and I would debit retained earnings, okay, if I had a loss. So in that case, I'm decreasing retained earnings if I have a net loss. That would make it go down. Now, we're only going to have one or the other. We either have net income this year or we have a net loss this year. So whichever one we have, the other one is not going to happen. So if I take a look, okay, here is my net income, 3350. Okay, is positive net income. Okay. Okay, so 3350 net income. Now, because I had net income, I don't have net loss. So you can just cross it out. But there is something else that decreases retained earnings. When we close out owner withdrawals, we debit capital, or in this case, retained earnings, and we credit the owner withdrawal account if it's a sole proprietor, or it will usually be called dividends if we have a corporate account. So the owner withdrawals is where the company gives out money to the owners or investors. And when it's a corporation, that owner withdrawal money that's being handed out is called dividends. The company is issuing dividends or paying out dividends. Okay, and so that's also going to make it go down if we pay dividends. Okay, so now we know we can figure out that if we started with 3705 and then we had net income of 3350, and let's see if I can. Okay, so we have 3705 plus 3350, and we subtract out the 3085 balance, and the difference is 3970. Okay, so here here we have all of our information. Now our net income went on the operating. Here, let me erase all this stuff. Okay, the net income was our very first number in our operating activity section. So we should already have that if you already started on the statement of cash flows. Otherwise, that will be the first number that you start with. Okay, in the financing section, we'll have to put paid dividends 3970. Okay. We want to double check that the 3705 plus the 3550 minus the 3970 equals the 3085, and we can make sure that that happens as well. So at this point, we have now taken care of all our long-term assets, long-term liabilities, and our stockholders' equity accounts. We have analyzed them, what makes them go up, what makes them go down, made sure that they all checked out, and